Hello, dive traders. Good to see you again. Today is really important update because something big recently happened in my portfolio, and honestly, it feels great to finally say it out loud. I just recovered the entire drawdown from the April Trump tariffs crash. Finally, all of it. And yeah, it took me 7 months. 7 long months. A lot of grind, a lot of stress, a lot of learning. But the funny thing is, if you've been with me on this channel, you already know this wasn't a quiet recovery because I didn't disappear. I didn't turn off my camera and come back when things looked good again. You saw every step live. Every month I opened my Interactive Brokers account right here on YouTube and showed you the real numbers. Green, red, ugly, painful, basically everything. And I believe not many channels do that. Most show you backtests or perfect fancy Excel spreadsheet or some hypothetical, this is what I would have done trades. But here you see the real thing, my real portfolio in real time. No filters, no cherry picking, no screenshots, no Excel spreadsheets. And today we are going to talk about what actually happened, why this drawdown existed in the first place, and what the recovery looked like week by week. All right, let's jump to the chart. Okay, here it is. This is actual PNL from my Interactive Brokers account. You've seen all this view many times in my monthly updates, but now we can finally see the full story on one screen. Right here, this big sharp drop, that's the April Trump tariffs crash. And trust me, it wasn't a small move. It was fast, violent, and completely unexpected. Um, Trump said what he said during the Liberation Day. The market reacted instantly, VIX exploded, and everything dumped at once. But here's the part that still hurts when I talk about it. My portfolio was perfectly fine before that drop. Seriously, it was hedged, balanced in a great shape. I had my famous Black Swan Hedges on. Everything was positioned correctly, and the plan was solid. And then I made one small human mistake. One moment where I didn't follow my own rules, my own trading plan. So, what happened next? The first wave down wasn't the problem at all because my hedge caught it perfectly. Honestly, it was beautiful. The market dropped, wicks exploded, and my hedge was printing huge profit exactly the way it was designed to do. And that's exactly the moment where I made the mistake. Because when I saw that big profit, I thought, okay, great, I will just take it off now. I think the market, the move is done. I will be smarter than the market this time. So it was classic overconfidence, trying to outsmart the system, trying to optimize something that didn't need optimizing. So I removed the hedge, and literally right after I removed it, the second wave of selling hit hard. Suddenly, the whole portfolio was exposed. Buying power dropped fast. Positions needed emergency adjustments, and you saw it all: the panic, the stress, the messy rolls on the videos I posted back then, and in the community tab on YouTube. So that's exactly how it happened. That's why this recovery took 7 months, because one moment where I broke my own plan and I paid the price for it. So back to the chart. Um, Now look at the right side of this chart. You see the slow, steady climb back up. This part didn't happen in 1 week or one lucky trade. It was small wins, consistent adjustment, daily management, and letting data do the work. Every month almost I showed you the new P&L, the positions I opened in the community tab, the hedges I rebuilt, the comments I had about volatility, and most of the trades I closed or rolled. Every single piece of it is on this channel. And here we are, back to the high water mark 7 months later. But the important part is the transparency. All of this was live. You really watched me go through the drawdown step by step. And I believe that's the only honest way to show real trading. Because trading is not about, like, I made $100,000 this month. Real trading is about strategy, about risk management, about hedging, painful mistakes, emotions, and patience. And you saw all of that here. So yeah, this drawdown was painful, but it was also one of the most important experiences I've had in years. Because when you see your mistakes literally on chart for 7 months, you learn faster than any course or option book could even teach you. And I'm sharing all of this because I know many of you watching trade your own money, your own accounts, your own portfolios. And it's easy to think you are the only who messes up. You are not. You are not alone. I'm right there with you. The difference is that my mistakes are on YouTube. Yeah. So So let's talk about the hedge itself, because a lot of you keep asking, what exactly is your Black Swan hedge? How does it work? Why does it explode exactly when the market collapses? So if you've read my trading plan, you already know the core version. And in my own trading, I use multiple variations of it, depending on volatility and market conditions. But philosophy is always the same. A Black Swan hedge is basically your airbag. It sits there doing nothing until the moment you really, really need it. And then, when volatility explodes, things goes crazy, exactly like it did in April. It really saves your entire portfolio. And what's important, a good hedge protects you in two ways. First way is P&L. It prints profit when everything else bleeds, so it's delta hedge. But also very important is buying power. It keeps you account from getting margin call during big spikes. And most traders only think about P&L part. But the most important thing the hedge gives you is breathing room. It gives you more time to adjust, to roll, to manage risk without panicking. And that's why removing it early was the worst decision I could have made. So, today I want to walk you through something every option seller must understand: Black Swan events. Why they destroy portfolios, why most hedges don't work, and maybe how to build a hedge that actually survives a real crash without bleeding your PL every month. Let's start with the idea of Black Swan, but the real definition from Nassim Taleb's book. So, in his book, The Black Swan, Taleb describes three qualities of true black swan. First, it's rare. It lives outside our normal expectations. Second, it has a massive impact. It can change the system. Third, we create explanations only after it happens. So we convince ourselves it was obvious, even though nobody was positioned for it beforehand. And when you apply Taleb's idea to markets, a black swan is not simply a big red candle. It's not kind of -2% day, or not a CPI miss, or not Powell's or Fed headline. A market black swan is regime shift. It's the type of event where volatility goes vertical, correlations between assets jump towards one, liquidity disappears, and the entire market moves like one single trade. So the COVID 2020 crash had this profile. 2008 had it, 1987, if you remember, had it. And in my personal opinion, the Trump tariffs crash in April 2025 had a Black Swan signature because it was so fast, so violent, with the S&P down almost 20% from heights and the VIX spiking into the 60s. So um, these are the moments that kill short volatility traders. Not the slow pullbacks, but the sudden volatility repricing that Taleb was talking about in his book. All right. Now I want to stop for a moment and show you something extremely important. It's from the Tasty Life research team. This table alone explains why black swan events are so dangerous and why normal diversification completely fails. Here's the correlation table from a Tasty Life study. It shows how different assets move relative to SPY, but at different VIX levels. So let me walk you through it slowly because this is a huge, really huge insight. So when VIX is above 20, the average correlation between selected assets here is 0.66. Okay, so even at VIX just above 20, which is not even a crisis, you already see correlations climbing. If you think you are diversified because you own airlines, emerging markets, Apple, energy, uh, consumer staples, guess what? They're already moving in the same direction 2/3 of the time. But that's the calm part. Let's move to the real problem. When VIX is above, uh, it's above 30, average correlations is 0.73. So now we are entering stress territory. This is the moment when most traders start saying, why is my whole portfolio falling? The stocks were supposed to be uncorrelated. Nope. At weeks 30, over 30, your diversification already doesn't work. Almost everything starts behaving like the same trade. Tech stocks, airlines, commodities, emerging markets, maybe gold, completely different assets, completely different fundamentals, but the same direction when the fear enters the market. And now let's get into real chaos. When weeks is above 40, the average correlation here goes to 0.84. Now this is the black swan zone. This is exactly the environment Taleb describes in his book. Look at Apple, for instance, 0.30, 0.93, EEM 0.89, even XLE energy is 0.86% correlation. So at VIX above 40, your diversified portfolio behaves just like S&P. So in a real crash, diversification is dead. That's why portfolio managers panic and so many short volatility traders blew up. All assets collapse together. Diversification protects you. Yes, it protects you in normal times, but black swans are not normal times. So, key insights you must take from this table. When volatility spikes, correlations go up. Diversification breaks. All your long deltas move the same direction. Everything that was uncorrelated becomes a single trade, and your portfolio loses its natural protection. So this is exactly why you cannot rely on diversification or cannot rely on our favorite sector rotation or just stay long the market. During a black swan, the only thing that protects you is convexity. So smart, asymmetric options structures that gain value from volatility and skew. So as you can see, this correlation table is the real reason my Black Swan hedge exists. Because if you are selling premium without a hedge and VIX jumps above 40, you are completely naked. So what people think is a black swan hedge, and why simple hedges fail. The most popular hedge is what traders call tinnies, which are far out of the money long put options on SPX index for like usually, let's say, $2. And it sounds very smart. Tiny cost, huge payoff. Or some traders say, buy tinnies to own Lamborghinis. It sounds really lucrative, isn't it? But tinnies are Taleb's definition of fragility. They bleed constantly. They almost always expire worthless. They only pay in a sudden deep crash. If we have slow markets, slow bear markets, there is no payout. Sideways markets, no payout. Grinding drawdowns like 2022, no payout. So you keep paying, and you keep paying, but the hedge doesn't help you in real world scenarios that destroy short volatility portfolio most often. So I created this backtest of buying 10 delta SPY puts to show you exactly that. You can see tiny spikes of profits and long periods of steady losses. That's basically slow financial erosion. So I went in a different direction. I asked a simple question: how do I create a hedge that protects me in a black swan, but doesn't punish me every month when the market is normal? I wanted something completely different. I wanted something that is theta positive, or at least theta neutral, not a constant time decay bleed. I wanted something that protects not only deep crashes, but also in mid-sized high volatility pullbacks like August 2015, if you remember, Volmageddon 2018, or the Tariffs Crash 2025. And something that actually scales with the size of a short volatility portfolio. And as close to cost-free as possible, or can even be opened for a net credit. Yes, I open Black Swan Hedge for a net credit. I don't pay anything for it because buying put options, buying tinnies, don't give you that. I wanted something much smarter. That's when I turned to the idea of Black Swan Hedge. And if you own my trading plan, you already know exactly what structure I'm talking about, you know, the logic behind it, the ratios, the everything. And now let me say something honestly here. I was thinking about this for a long time, a very long time, whether I should share the Black Swan Hedge publicly on YouTube, because I know for 100% this will make some people extremely angry, like very angry, because there are people out there charging thousands of dollars just to show you a structure that is similar to what I use. And if I post this for free on YouTube, yeah, let's just say some of the gurus might try to report this channel and complain. Who knows? I've seen it before. This industry can get very dramatic when someone shares something valuable for free. But let's make a deal. I always try to be transparent with you. You saw my portfolio live, you saw my mistakes live, you saw my recovery live. So why not also show the hedges that save me in every Black Swan event? So I will make you a promise. If this video gets at least 20 comments asking to show the Black Swan hedge, just 20, I will record a full video and show you entire structure completely for free. I want to be sure it's something you actually want, because once I post it, there's no going back. And I know certain people in this industry will not be happy about it. So yeah, I think I showed you the most important takeaway. Never ever remove the hedge that protects your entire book just because it's showing profit. If you want the full version of the Black Swan Hedge is in the trading plan. If you want it for free, just drop a comment below. And thanks for watching. Thanks for following my journey live. And I will see you in the next update.